Okay, all right. Thank you. So for like Onchain, Coinmetrics, they're doing a decent job. And but the data that our team can, like, let's say, pull out of ETHScan is a lot more efficient than, relying on the third party.
Yeah.
So that's what we meant. So yeah, I think I should just do this presentation view. So anyway, so we're a hedge fund, multi-strat. We are known for providing liquidity, risk management. We say it basically means that we're doing a lot of treasury stuff now. We'll take your assets in exchange of like USDC or any native token, and then like let you earn yield. So you're basically hedging your risk. And then all of our investors are institutional at this point. We're at 280 million AUM. Yes, we're ranked at top 15 crypto native funds. And then, obviously we're very honored to work with like almost, everyone from like prime brokerages to funds to family offices and token projects. This is what the current derivatives map look like, centralized and decentralized, for future options, structured products, vaults. This area has gone a lot more popular in past few months alone, and that's what I was talking about. Now, the thing is with crypto option vaults is that retail investors are basically parking, or like, let's say, investing into a yield strategy. We're saying that, okay, I would buy 15, ETH calls, and in return, I would get 2 to 3% yield on it, APY. And on the back end, these platforms would make us auction for those tokens. So that's where the yield is basically generated. And it's not only us, there are like multiple hedge funds that are involved. And this has taken off quite a lot. Obviously, the entire decentralized options market, Arrows, Asteria, Open, is also up and coming. But options won't take off unless and until it's perps taking off first. And we started seeing like a lot more value over perps like coming out and about. So obviously we see like the structured products becoming more of the star, because basically where your money stands, and you can pick a strategy that's more specific to you. Late last year, it was just Ribbon Finance. Right now, there are over 15 protocols that are doing structured products, and this is just on Ethereum. Just imagine with like all emerging chains, with all other chains, how much of product development we could see around here. But these guys are like also trying to be multi-chain, so let's see how that goes. StakeDAO was very much present at ETHCC, so but they're one of the great examples for it. Obviously, the derivatives journey has grown. Back in the day, even when the fund started, it was just LedgerX, which is now called FTX US Derivatives. We're owned by the same holding company, and the holding company was acquired by FTX mid last year. We're the hedge fund, they're the exchange, and but we're operationally independent. FTX launched their perp platform in 2019. And the thing with FTX derivatives was that LedgerX, because they had all of the US licenses that were needed to trade options. Why is a license needed? Because option positions are fully collateralized. So if basically collateralized means that if you're buying a call, you have to put up $20,000 worth of that call, or the number could be anything. And if you're putting your money into something, according to US laws, they need some licenses. So FTX, LedgerX had DCA, DCM licenses, which FTX needed, so FTX acquired them. That same principle is on these DeFi protocols. Unless and until you don't park your options, or if you don't park your collateral that you're planning to buy the structured product with, there is no value. So basically, this entire ecosystem, whether it's a very centralized form of CeFi or DeFi, options or derivatives are mainly fully collateralized. So there's no situation of leverage anywhere, which I know is a very big topic for past few months or so. Going back, obviously CeFi is very limited in a way: delivery speed, limited offering, volume transparency, and liquidation risk. Again, what Mike, right? So Mike and I were talking about that. For CeFi, it's very hard to see where these OTC desks are buying their options from, where on what volume it's being sold, and that data is still very limited. Obviously, DeFi is a lot different at this point. DeFi technically started building 2018, right? But the first product initially took off when DYDX launched, and then now you have synthetics, open, and whatnot. In 2022, it's a full-blown ecosystem. And why it's been working so far is because it's just simple. If you go on to Ribbon Finance right now, you'll see how simple the UI is. So there's no complexity as compared to let's say FTX derivatives. You're earning yields, which DeFi has been great for. Concentrated liquidity, funds like us that are on the opposite of side, we know on what position we're providing how much money, and then what position is getting value. And then broader audience, anyone sitting out of here, any other country in the world can just trade them. But the newer version of DeFi options are option wallets. They're growing from phenomenally, and I won't be surprised that by the time we come back next year, there are 10 more projects like StakeDAO or Ribbon that have launched and that have accrued a lot in value. Especially the recent CeFi crashes have shown that yes, you can earn yield in a very good way, but it's just that you have to be smart and you have to stay away from leverage. So the growing number of locked contracts obviously has grown, which when I say locked contract, it means that once you've put in your collateral, once you've said, I'm putting in $5,000 worth of ETH, and in return I'm earning 4.5% APY because a structured call would make me that kind of money, you can't unlock it. You cannot say, okay, yeah, tomorrow I'm just going to sign off and take my money out. It doesn't work that way. Then you're just losing that yield value. There's a lot more digital assets listed while we speak. Like I mentioned, most of our Ethereum and BTC focused, but we've started seeing Solana, we've started seeing Avalanche, we have started seeing FTT, Luna was a hit, didn't go well. We started seeing Celo here and there, but for now, Ethereum and Avalanche, Ethereum, Bitcoin, Solana, and Avalanche are in most of the top ones. Challenges and improvements. Obviously, these positions require a lot of capital efficiency. The fact that it's fully collateralized basically means that you're leaving, the capital that you have needs to be locked up. It's not leveraged. It needs to be locked up in order for you to take, advantage of it. So that means you're just like less than $5,000 short, because it's like locked in this, particular strategy. Fund running DOV, basically, we know that at the end of the day, these auctions happen like 5 in the morning, it's Eastern Standard Time. This much is going on, this much is buying and selling. I think it's my Discord. Oh, you need his Discord channel. That's fine.
No, it's like getting constant pings.
That's mine, I think. I think it's mine. Sorry. There you go. No, it's mine. Sorry. No, I wanted to do it too, but I was like, do I finish talking or do I close my Discord? Front-running DOVs, like, you would never know, but we would know that, at this time, this is the auction. And if you don't provide enough, pricing option, then this isn't going to work. So, and these timings are literally 3 in the morning or 5 in the morning from where we're based out of New York. Yes.
What are those?
These are called Dutch auction vaults.
Okay.
So you take this, you start earning, let's say, okay? Let's use the strategy, okay? This is a trading strategy, covered call. And I'm going to say deposit. Whatever the amount I deposit, I connect my wallet in it. On the back end, Ribbon Finance is going to take the money that you have posted, like let's say it's 5 ETH or 10 ETH, and auction it to us to earn you that yield. So it's called auction vaults. And and they've become pretty big in DeFi. And these, so many of them like Seta, Theranauts, they were literally started by hackers, and Theranauts got funded by QCP, which is another hedge fund. So underperforming for retail investors that don't mind on the delta risk, like DOVs are a perfect product. However, for investors that are not properly hedged, holding an overriding position for an extended period might result into an underperforming market, which technically means is that, let's go back to Ribbon Finance. So if these kind of strategies are your, if you know enough about options, or if you know enough about derivatives, like if you're running this strategy for, let's say, okay, staked AVAX, current vault, strike price is 32. So basically what this means is that right now, what is it at the price stat? So yield is your negative value. But at some point it was 240. So if you haven't priced it, like let's say over $32, then you can lose your value. Then you'll just get the $5,000 deposit you've earned, get it back. But if your strike price was lower than 32, then you would make the money. So that's basically what in the on the trading side we call hedging. So that's what I mean by that. So underperforming, yeah. So if you haven't used your exercising value as well, then you can lose value. So there's always a risk on that. So far, I don't think these vaults have lost any kind of value per se. But the also reason is because the volumes on them haven't hit the $1 billion mark. That's what BitMEX or Deribit is doing. So if that happens, then obviously this could change. Obviously, risk is very high because Ribbon has built their own risk infrastructure, and if someone was to hack them tomorrow, all of these staked assets that are locked onto them could get lost. It's not as bad as the other DeFi protocol hacks that we've seen. We've never really seen, an auction walls getting hacked. And then analytics and data transparency, again, which is great, right? Like you get all of the on-chain metrics, but at the end of the day, if this is the side, or this is the the idea that you want to build, we would like to see, and I can show you my Telegram, that's, where we say how much this auction was bought at. So the price needs to, we would like to see the price that instead of $32, what was it at, $5, or was it at $10? That's a metric you don't find. But on the centralized exchanges, on Deribit and BitMEX, you can spot that. So, but they're coming far, and then that's why, Mike asked on the on-chain metrics that, these are the kind of data, at the end of the day, we're always, looking for.
Yeah. I think it's also good for, retail investors, too.
Yeah, exactly. Full transparency, basically.
Yeah. It's you can, if I'm more sophisticated, I can go on-chain and look for all of that, but it's better, if you can provide it on the front end, or, a subgraph, or,
Yeah, so, but yes, so this is DOV. This is what DeFi derivatives are. If you're building, one thing that DeFi has really worked on, and that's why we're here, we're sponsoring the hackathon, and we're giving out prizes on Sunday for the same reason. We've seen it work very well for trading applications, especially for options and derivative side. And we have supported each and every one of them. So if you're building, you're looking for ideas, look into this, and look into basically any centralized trading traditional market that has been doing. How can that be translated to a DeFi? Index funds still haven't made the crypto market yet. Structured products just started now. Higher yield products, other than just farming and pooling. What else could that be? There's always a market for that in crypto. So I think that there's an open market while you guys are working on it. So yes, any question. Now I would just next few yes.
So I guess the issue is, or not issue, but with Ribbon, you're essentially moving a lot of size in the markets, and I sort of alluded to with
DeFi market.
Yeah. But you're moving so much options volume. Does it sort of affect
the centralized volume? No. Yeah. I wish. No, not there yet. I wish, but no. The answer is no. The reason is because the entire size of Ribbon of one trade is CMA's half day of a trade. So no, we're not there yet.
What do you think is the kind of ground that DeFi needs to cover before we're starting to rival BitMEX and a few other fields?
KYC? So if you would ask any of our institutional investors, so basically who's trading on CME, right? I have a friend, he used to work with us, Chicago trading company, and he has been trying to get approvals from his fund to just even get to trade on CME, just because these are fully collateralized position. There's no counterparty risk. You're just exposed to limited market, and all of the counterparties are fully KYC'd, so your money is safe. That's the surety DeFi doesn't really have right now. For native, yes, because we know at the end of the day, like we'll call up, like let's say QCP, and we'll say, "Oh, are you the other party trying to make this market?" And they'll say, "Oh, yeah, yeah, it's me or someone else." But for someone like let's say Jane Trading or Citadel, they they won't be open to that.
Okay, so like I guess would something like Aave Arc like, where essentially you just have this KYC market, and then you have all the activity happen there, and have some crypto natives like Arc to spread?
I have no idea why we haven't looked into our Aave Arc yet. I think we probably would have a reason, but yeah, something like Aave Arc.
Oh, I mean, I think with Aave Arc in particular, like the yields are just so low that.
Okay, maybe that's the reason. Okay, maybe that's the reason. No, we
I mean,
yeah.
it's more like about that kind of setup.
Yes, the KYC setup, yes. And once you get that comfortable, then obviously you could see the CME, the BT, BitMEX, and the Deribit kind of sizes. But Deribit has lost some money with like 3 arrows. So, yeah.
Haven't we all?
No, we haven't. No, we haven't. Okay, no. I took my sweet little time for shopping this. No, no. But it's unfortunate, right? So, yeah.
Is one of the ways that they're able to receive, I mean, obviously they're both fully collateralized, but one of the efficiencies with the centralized one